panel bar, which I will introduce shortly. But to start us off,
I want to thank you all for your time. In the next 1 hour, 30 minutes, we're going to be delving into a number of topical issues, which we consider to be some of the top of the line issues within the banking space today, from macroeconomic issues to cybersecurity to employee issues.
Recording in progress.
We're also going to be talking about the recapitalization. So please sit back, sit tight, and listen as we begin to discuss some of these very topical issues. You will be given the opportunity to ask your questions. Bimbo is going to take us through the house rules in terms of how you will interact with the panelists. But I think what's important is that we all listen and take something back from this session. Thank you very much for your time.
thank you, and just welcoming everyone again to what is going to be a great hour and a half of our time. I'll start by taking us very briefly through the agenda for today. We'll start with a number of conversations around general concerns for banking executives, but likewise FSI professionals as a whole. And then we'll delve into the more narrow issues around recapitalization concerns. This will be followed by a Q&A session where we will take some concerns and queries from the audience and seek to address those just based on the insights of our esteemed panel. And then we'll close off the session while still giving you the opportunity to reach out to us for additional insights subsequent to the session. I'd like to, at this time, just introduce our esteemed panel bar. We have Dayo Omolokun, the Chief Financial Officer for Standard Chartered Bank, with us. Dr. Ayo Adepoju, the Group Chief Financial Officer for EcoBank PLC, is with us also. And we have Tunde Mabanku, the Executive Director of Finance for Wema Bank PLC. These esteemed professionals will also be joined by some of our in-house leaders in the FSI space. Ashiata Agoluwaje, partner, tax and regulatory services here at Deloitte. Akinola Akimboboye, partner, financial advisory services here with us at Deloitte, as well as Uyi Izeko, our West Africa financial services industry leader. At this time, we will go through a brief profile of our esteemed panelists, and as we wait for the backdrop to come up, I'll just take us through a few of the house rules. The Q&A session will be open throughout our conversations. We're very happy to take your comments, your questions, your contributions throughout the discussion. We will aim to get through all of them in the course of the Q&A. Our attendees will stay muted just to minimize disruptions through the session, but all of your contributions, to the extent possible, will be addressed during our time together. We'll also have an email where you can share additional insights and perhaps an invitation to have further conversations on the back of today's session. Okay. In terms of the profile of our speakers, I'll just give a minute so that the profiles are shown, and then I'll take you through the DNA of each esteemed panelist that we have with us today. starting with Dr. Ayo Adepoju. Dr. Ayo Adepoju was appointed Group CFO of EcoBank in August 2019. Prior to his current role, Ayo was the Group Head of Business Performance and Analytics. He worked on strategic aspects of the financial management of the group, including private equity and close interaction. Prior to joining EcoBank, Ayo had a career at PwC in London and Lagos as Audit Assurance Manager in the financial services practice. He's an accounting graduate of the University of Lagos, Nigeria, where he earned a BSc degree with a first-class honors, followed by an MBA from Warwick Business School in the UK. Ayo is a fellow of the Institute of Chartered Accountants of Nigeria with a national overall best prize award at 2 consecutive stages of the ICANN exams. He's also a fellow of the Chartered Institute of Management Accountants. Ayo has attended executive education courses at Harvard Business School, Wharton Business School, and London Business School. He holds a PhD in organizational leadership at Regent University, Virginia Beach, USA. Welcome, Dr. Ayo Adepoju. Okay. Next, we have Mr. Dayo Omolokun. Dayo is a seasoned finance professional with 3 years of multifunctional international experience in Africa, the Middle East, and UK markets. As an organizational leader and commercially minded C-suite executive, he balances the responsibilities of stewardship and business partnership, constantly improving shareholder value through strategy formulation and execution, as well as business risks mitigation. He also manages investor relations and key regulatory relationships. Dayo is currently Managing Director and Regional Chief Financial Officer of Standard Chartered Bank, overseeing strategy, finance, property, and supply chain management functions across the West African corridor, straddling Nigeria, Ghana, Cameroon, Cote d'Ivoire, Gambia, and Sierra Leone. Dayo has successfully led the West Africa franchise to navigate prevailing tough macroeconomic challenges, particularly in Nigeria and Ghana, strengthened key balance sheet metrics, specifically capital and liquidity, grew revenue faster than cost, has driven operational efficiency, and delivered acceptable returns to shareholders. Welcome, Mr. Omolokun. And the last but not the least of our esteemed external panelists today is Tunde Mabanwoku. Tunde is Executive Director of Finance at Wema Bank. Tunde is an Executive Director of Retail and Digital with over 23 years of work experience. He's a seasoned financial professional. He's gained vast experience in financial control, in strategy, tax, cost management, investor relations, corporate sustainability, human capital management, business performance, credit risk, and customer experience. He has extensive experience in banking and the oil and gas sector. He has a bachelor's degree in economics from the University of Ibadan, Nigeria, and an MSc degree in finance from the London Business School of the UK. Tunde is a chartered accountant. He's a fellow of the Charter, an associate of the Chartered Institute of Taxation of Nigeria, an honorary senior member of the Chartered Institute of Bankers of Nigeria, a fellow of the Institute of Chartered Accountants of Nigeria, and an alumni of Harvard Business School GMP. Welcome, Tunde. And with us, as part of our internal panel bar, we have Ashiata Agoluwaje, who is a partner in our tax and regulatory services for Deloitte West Africa. Welcome, Ashiata. We also have Akinola Akimboboye, Partner Financial Advisory Services, West Africa. Welcome, Akimboboye. And Uyi Izeko, who is our FSI West Africa leader in Deloitte. Thank you. So we delve straight into the business of the day. There are many conversation points, and I'd like to start with just a general conversation around the things that keep us awake at night. If I start with Dio, Dio, you've been at the helm of affairs for quite a while at Standard Chartered. I think I want to start with the conversation around emerging technologies. So if we think of emerging technologies such as, generative AI, do we think of these as threats or opportunities, or indeed both? And I'll let you get into it. How do you think banks should capitalize on these emerging technologies that are currently evolving in the FSI space? And we see some of them enhance market share, but we also see some of them encroach on market share. And how do you think this would, impact customer satisfaction to just foster good competition within the industry? So over to you, Dio, on your thoughts here.
Good morning, everyone, and thank you so much, Bimbo and Uyi, for having me. I think you're spot on. The issue of whether technology or what we call AI is a threat or provides opportunity is something that is very real. But let's try to unpack that question. I think you did mention generative AI. AI, first of all, is pretty much what it sounds like. It is the practice of getting machines to mimic human intelligence to perform tasks. And I think most people have actually interacted with AI, even if they don't realize it. For example, many companies or even banks use voice assistants, tools, even on personal devices like the iPhone. You have Siri, you have Alexa. All of these two are founded on AI technology. Banks and other companies also use customer service chatbots that pop up to help you navigate websites. So the point is, until recently, machines were used to predict models. They're used to observe and classify patterns in content. But of recent, with the development of generative AI, you now have machines that are able to create images or content. Like I said previously, what you would do is to provide the content or the images to the machine, and the machine will try to look at patterns. But right now, with generative AI, based on data and based on its own learning, it can actually create new set of data or new set of content on demand. And that is why you have tools like Chat GPT being used. The recent breakthrough in this field has actually drastically changed the way we approach content creation, and it also has impact on services that banks do provide. And many of those benefits are there. Like I said earlier, some of the banks have used chatbots to interact with customers in terms of resolving customer issues. Other benefits include the personalized financial services, where based on the trend of your transaction that you have done through your account based on the lifestyle information that the machine is able to pull together. It can use all of that information to prescribe or personalize financial services for you. So take, for example, someone who is in the mid 40s, perhaps some of the types of expenditure he does will relate to maybe payment of mortgage or rent or payment of school fees or cost of living expenses. But when you are in your 60s or 70s, many of these expenses would have disappeared and become something of a lifestyle. You just want to travel, you want to see the world. AI is able to piece together all of that information to prescribe, particularly if you have surplus funds, to prescribe how you can invest your funds. It can also be used in data analytics as a combination of so many things to enhance customer experience by interacting with you and providing on-demand information. Many tools can easily respond to your queries without wasting too much of time, and that does improve customer experience. Internally, buyers can also use it for process automation, where mundane tasks automated fully to ensure that they cut out on unnecessary inefficiencies and they become more effective. I think one of the biggest advantages of using AI is also in fraud detection and prevention, where based on series of patterns and based on series of predictive data, and the machine can detect whether something has gone amiss or not for a particular transaction. And in many cases, it can actually not just alert the bank itself, it can also alert customers in terms of what is happening to their transaction. Some banks can also use it in terms of credit scoring. I know a few banks already have pre-approved credit limits where you interact with the app and you'll be surprised and it tells you that you've been pre-approved for maybe 1 million naira or 2 million naira of personal loan. That has been done or enabled based on generative AI and based on data that the machine was able to pull together. Now, for every single benefit, it's always a two-edged sword when it comes to technology. It does have its benefit, but it also poses a lot of threats to the way we do business. The most important or the most significant part of that is data privacy and security. Because increasingly you're expected to provide personal information, which the system is able to pull together. And in many instances, if you are not careful, you can actually provide every important information that can be used to actually mimic you in terms of transaction. So data privacy and security is a big issue, also largely because of increased data breaches and and set of information which customers are expected to provide. There are also ethical concerns in terms of what AI is able to do. And at times, you need to be careful to know whether what the content that has been provided is actually real or not. And at times, it's so difficult to detect what is real and what is what they call augmented reality. The generative AI can also pick up on biases and fairness. It can, because it's based on data, and if the data that is used is is biased towards a particular leaning, then it's going to pick it up because it's based on data and it interacts based on data. So, which can also lead to unfair outcomes. For example, if someone had already had issues concerning fraud, okay, and maybe it wasn't even proven at the end of the day, but because the data is still there, it's not been cleaned up, the system will continue to use that set of data to take decisions. There are issues around regulatory compliance as well. Generally, banking is possibly one of the most regulated industries in the world. The regulators are concerned, and that is why series of legislation circulars come out around that. A key one is the Nigerian Data Protection Regulatory Regulation, which came out in 2029, which required financial institutions to adopt, if possible, adopt AI system for compliance. I think lastly, the last point I want to make on trade is around the skills gap. The fact is that most financial professionals feel unprepared for AI technology, AI adoption, due to the shortage of AI expertise. And they also feel that generative AI will take over jobs, but some of those concerns can be alleviated because yes, it's going to take away certain jobs that are mundane related, but it's also going to create a new set of jobs for those who are prepared to adopt technology. So overall, I think my summary is that AI or generative AI, first of all, is here to stay. It's part of how we work, how we live. It's part of how we take decisions right now. It does have massive benefits to make things easier, not just for banks or businesses, but also for customers of banks who want services on demand. But at the same time, it does have like a two-edged sword. It does have its own threats and challenges. Thank you.
Thank you very much, Dio. I think that was super insightful, and I picked quite a lot from it. So in summary, there are some opportunities, some very good opportunities, but there are also a lot of threats that we need to look out for and mitigate as we go along. Thank you. I'll move across the bar to Ayo. Dr. Adepoju, over the past year and more frequently over the past few months, the macroeconomic indicators have shifted, in a volatile way. And as an executive, and just given your experience in the industry, what are some of those impacts, around indicators like foreign exchange, on the banking industry? What are some of the strategies that you think the banks need to explore to mitigate some of those volatilities? And what do you see as the future for the banking space as far as, the volatilities around FX are concerned?
Yeah, thanks, Bimbo. I think generally for banks, it's all about managing risk and volatility. So that is why banking entities are, financial intermediators, right? So you sit in between the surplus and the deficit. And if you think about it, most of the news in the media talks about, when the economy is not doing very well, banks are declaring excessive profit and all of that. If you look at the fundamental design of banks, because you're meant to intermediate, you're meant to sit in the middle. So you're basically in between two ends of the wall. There's a benefit of sitting in the middle rather than sitting at the edges, because when you sit on the edges, that is where the risk is very, very high. But coming specifically to the risk of volatility for FX, right? Like we've seen, just not just in Nigeria, of course, in most part of Africa, where we've seen material currency depreciation. Take a look at last year, for example. We ended the year at about 950 naira to $1. The beginning of the year was about 460 thereabout. And not just Nigeria. You look at Ghana, you look at Zimbabwe, for example, and of course you've seen the recent trends that is happening in Zimbabwe, where their currency, lost over 70% within the first 2 months, and they've had to introduce a new currency in that market. So the risk of volatility is high, particularly for banks. I think let me just highlight two major risks or concern as a banking executive. One is the area of credit risk, and also the second is an area of the capital risk. Starting with credit risk, especially where you have volatilities in the exchange rate and all of that, it creates uncertainties for businesses in the market. When you cannot plan, especially for the medium and long term, it creates disruptions in the market for businesses. And there are lots of research, and even by rating agencies that have highlighted the negative consequences of FX volatilities on the businesses of clients, whether it is corporate or at the retail end. The thing about it is that in the short run, you might not see some of these weaknesses because they're kind of marked with a couple of other things. But in the medium long term, you start seeing a sustained pressure and weakness in the fundamentals of some of those businesses. So that is one material item or risk item for banks to be very, very mindful of. And I think it's important at this time, of course, to stay closer to the customers, to redesign your strategy in terms of where you want to play and all of that. So it is very important for all of the credit risk management policies and practices to be reevaluated. So that's the first step. The second thing is from a capital standpoint as well. Because I know for most countries, not just in Nigeria, capital is held in local currency to a large extent, especially the common equity is held in local currency, right? And then you do banking businesses both in local currency and in foreign currency. So your asset base is a mix of both local currency and foreign currency, right? While your capital, especially common equity, is largely local currency. So that is a mismatch because when you have, for example, a currency depreciation, right, you would have what we call the risk-weighted asset inflation, meaning that especially if you have foreign currency loans and foreign currency assets, they become a bigger number as far as the Naira risk-weighted asset is concerned. If you know that, of course, capital ratio is a function of both your capital supply and your capital demand. Your capital supply is in local currency, your capital demand, which is the asset, becomes a bigger number. So it creates a pressure on your capital ratios as an organization. So what can banks do about it, right? So a number of options. One, fundamentally, you've got to run faster from an earnings generation standpoint compared to the impact of the currency. So you need to generate much more profit at a faster rate than the impact of the currency. I think the second thing to also explore is knowing fully well that your asset is a mixture of both local currency and foreign currency. You have to strategically also look at your capital supply and how can you introduce some elements of foreign currency in your capital stack as an organization, either through a foreign currency tier 2 capital or a foreign currency additional tier 1 capital and the likes, because what it does for you is that it helps you with the vagaries of the of the currency depreciation. And if you look at the Nigerian market, for example, where as of today, depending on which statistics you're looking at, if you look at the industry, more than half of the risk-weighted assets of banks is in foreign currency, right? This is just an average, of course. There are outliers. There's some banks that sit at the lower end. There's some banks that sit at the higher end. So you see that most banks, almost half of their risk-weighted assets sit in foreign currency. So there's a critical need to start looking at capital supply from the lens of introducing some foreign currency capital stack. And beyond that as well, it is important that, of course, you have to look at your risk appetite for foreign currency assets and all of that to ensure that you're generating the right level of returns that ensures that the impact on your capital in the case of devaluation is not that negative. So these are a couple of thoughts from the impact of currency volatility on the banking sector. Of course, there are other broader impact in terms of the operational side of things. We live in a country, especially in Nigeria, where it's largely an import-dependent country. So most of your resources, whether it is technology and all of that, they are purchased externally. So in a devaluing currency, so your cost of input goes up, and you need to think through properly how you price your product and services to ensure that your return on equity stays ahead of the cost of equity for the bank. So these are a couple of few thoughts. I'll just pause at this stage and take for the comment here.
Thank you very much, Ayo. I think those were very useful, framing ways to think about it, as well as just, think through the mitigants from a top-down perspective. So thank you. If I move to Tunde, so Tunde, just given your purview as well and the breadth of your experience, what emerging fintech trends do you think are most impactful for banking operations today? And what measures, do you think within the industry you can leverage to adopt these effectively? And maybe as a corollary to that question as well, would then be, how are banks competing with the smaller fintech guys who are maybe a bit more nimble with payments? Are these guys a threat? To what extent? Or are they enablers within the ecosystem?
Okay, excellent. Good morning, everybody. It's a pleasure to be here. I'll just make this brief so that we can go around it a little bit more. Initially, you mentioned, taking a step back, you mentioned what are the things that keep one awake at night, in fact, almost throughout the day. I guess for me, top on that list is what we call regulatory peace. If you can do a week without any query, sanction, or anything from the regulatory authority, then that has been a good week. And in addition to now growing concern around reputational and strategic risks. Because the little thing now in this world, this socially connected world, any little misstep or mistake can impact everything that you do as a business. But coming straight to the fintechs and what we see, there are a number of things that are doing that are changing the narrative. I guess top on the list for me would be around blockchain and distributed ledger. So a lot of things that we traditionally used to rely on, the traditional switches, traditional settlement approaches, with blockchain, all of that can now be done in an instance. And good enough or sad enough for me, I used to wear the finance hat, but now I'm transitioning to executive director in charge of digital and retail business. And I'm seeing a lot more of those technology plays impacting on our business. Open banking is here to stay. We'll be here for the long haul, where people can plug and play and choose services that they want from their aggregator. The first speaker mentioned a lot around AI and machine learning. I think even the little things that we do on a daily basis, those are already embedded. Now, the smaller fintechs, What are they doing and how can we respond? A lot of them now have services tailored at specific needs. So you have a fintech that the only thing they do is savings and they pay interest rates. You will have one where the only thing they do is buying and selling, or where the only thing one does is investments. But you as the financial institution, you do savings, you do investments, you do loans, you do almost everything. So it's almost impossible to compete with specialists in particular areas. But one of the things we've done in my place is first and foremost collaboration. Let us learn how can we work with these guys, maybe even to learn and understand the processes, the algorithms or things they have put in place, and then slowly over time develop those capabilities. And then also for organizations, we now need to almost start building our own fintechs within the larger organization. So we now have some incubation system, we do hackathons and little things just to make sure that we also have the talent pool and we can start doing smaller things better than waiting for committee meetings, taking to the board, taking to regulatory authority, and then coming back to implement. So to summarize really for me, a number of multiple balls that we keep having to manage. But in that industry, technology is here to stay, fintechs are here to stay. The winners will be those that learn to coexist, to partner with, but at the same time developing their own internal capabilities. Thank you.
Thank you very much, Tunde. I think super insightful as well. And just taking a lead from what you said, it seems like that train of thought around insourcing our own talent in order to grow the service or product repertoire is something that we all need to think about. And collaborations also, really resonate. Thank you, Tunde. Okay. I'm going to circle back to Dio. So Dio, when you talked about the emerging AI threats and opportunities, you talked very specifically around cybersecurity and data concerns. So my question to you, just in elaborating along that line, would be how much of a concern, and we know it's a significant concern, is cybercrime to Nigerian banks? What are the proactive measures that are being taken to strengthen the cybersecurity, trends, the evolving threats, and how can we ensure that our systems are robust enough to safeguard against potential data breaches?
Okay, thank you, Bimbo. First of all, in terms of whether the cybercrime is a significant area of concern, the answer is an absolute yes. And the reason being, one, banks or financial institutions, pool and aggregate a lot of data. The second thing is that we are responsible for people's money, their savings, and any breach in terms of cybersecurity could lead to substantial financial loss. But it's also important to realize that with technology, with advancement in technology, like I said earlier, there will be benefit, but also there will be is that since the pandemic, we have seen cyber attacks actually double at times, close to even triple, not just in Nigeria, but also across the world. The second point is that with greater digitization of banking and banking services, coupled with some others, the fact is the bank about whether it's going to happen is about when it's going to happen. And every business, and particularly banks, need to actually have proactive measures to put in place to prevent any substantial impact on their operations actually on this as well, because some time ago, I think in 2019 and more recently in 2024, the central bank issued the risk-based cybersecurity framework and guidelines for deposit money banks and payment services bank. Now that framework is risk-based and is expected to help banks to outline the minimum cybersecurity controls that they need to put in place. Now, going direct to the other part of your question in terms of what are the kind of proactive measures the banks need to put in place to prevent any substantial loss if these attacks do happen. Like I said, it's not about whether it's going to happen, it's about when it is going to happen and what impact is going to be. Number one is that banks need to ensure that they create robust security policies. It's very important that we look at that risk critically and not wish it away. Policies ensure that you lay a solid foundation for risk management. And when developing security policies, it's important that banks do an implement security framework, which will help them to safeguard their businesses. There is a need to also craft best incident responses and and disaster recovery plans, so that if the attack does happen, you can easily switch and recover as quickly as possible, because the speed of recovery is very critical, and also that particular security risk and update those regularly. Technology just use leverage on AI, leverage on machine learning, use deep analytics to ensure that you can predict and you can also ensure that you can prevent financial frauds, particularly from known security threats or emerging security threats. Things like unauthorized data access and usage, and it's very, very important that those things are actually not just reported, but they are actually analyzed to ensure that it doesn't happen again. A third point I'd like to make around this is around the continuous threat monitoring, knowing that it's just a matter of time before such attack will happen. Enforcement of zero trust. No one should, assume that your next door neighbor, has the same objective as you. So unverified access to your critical assets is very, very important. There must be very strict enforcement of role-based, privileged access to stakeholders, not just from physical security point of view, but also point of view. And increasingly, you discover that you have third parties who interface or who provide services to banks and businesses. Very important that you assess the technology risk.
Okay, I believe Dio's
components of your third party have
Dio, your internet. Okay. Okay. Let's give Dayo a few minutes, and he may be able to rejoin us once his technology is back and up to speed. But I think that a few things that I was able to catch from the conversation is that hope is not a method when it comes to cybersecurity. We have to measure the risk, monitor the risk, and educate everyone in the ecosystem just around access, both physical and virtual access to sensitive data. So thank you, Dayo. I think I'll move very quickly to Ayo. So Ayo, what is your view on how sustainability and ESG is impacting foreign funding?
Sorry, I got cut off there. Sorry about that.
Yes, thank you, Dio, and welcome back. So we will come back to you so that we can top up on that conversation. Let's move very quickly to Ayo on the next question. So Ayo, as we spoke earlier, you mentioned just monitoring that capital base and the credit risk and seeing how you can infuse, multi-currency layers there just to enhance the strength of the capital. Um, what concerns are sustainability and ESG from foreign funding sources? How does this impact, investor expectations in the banking sector? Is it a growing area of concern that banks need to create structures and better navigate in view of sustainability goals? What are your thoughts here?
Yeah, thanks, Bimbo. I think if you look at generally the sustainability topic, yeah, it's no longer a nice to have, right? It's becoming a must have. There was a time where you're having conversations around sustainability. It sounded more like a moral or ethical subject, right? It's no longer a moral or ethical subject. So it is something that of course, every company, not just banks, must embrace in this world. And just to share a couple of thoughts on this subject. So, for me, as a CFO, constantly, talking to analysts, trying to raise liquidity, capital, and all of that. What I've discovered is, most people that you talk to in this day and age, that begin to ask you questions around what exactly are you doing in the ESG world, basically. So it's no longer a soundbite. It's about what are your policies, what are your practices, what is the organization uh, doing. I think from their perspective, because they've realized that it is not so much about the short run, it's about the medium long term, right? What is the essence of making so much of profitability and then you are degrading your environment in the process, right? What is the essence of declaring this, billions or trillions of profits, and then you're not considerate about the climate risk for the organization? So these are topical subjects right now. I remember in 2021, 3 years ago, as an organization, EcoBank, we had to raise, which was the first time an issuer, especially in sub-Saharan Africa, issued a tier two sustainability bond, right? Which was in dollars, by the way. Speaking to what I said earlier, how to increase the capital stack with foreign currency is very critical. But at the same time, layering on top of that, your sustainability agenda, what exactly are you doing from a green space? What are you doing from a social space? What are you doing for women empowerment, SMEs and the like? So it's very important because, like I said, there's no point, running an organization that is not sustainable, right? So long term is always much more important for the short term. So as an organization, it's important that, of course, the tone has to start from the very top, right from the board level. There has to be a dedicated, governance structure around that. One of the committees of the board that, of course, is focused on sustainability, ESG. And that should trickle down the entire chain, the entire organization, right from the senior management to, of course, impacting on products and what we do as an organization. It is important also, of course, in this day and age where regulators are beginning to, for example, you have seen the new standards in terms of the IFRS S1, Sustainability 1 and Sustainability 2, which is a global standard, and Nigeria is one of those early adopters. So it's going to force organizations to start thinking through what exactly are you doing from a social or green or climate point of view. You would have to think about what is the impact on your governance, what is the impact on your strategy, how does it impact your risk management, and also, of course, how do you establish specific metrics and targets? Because it's not so much about talking the talk, right? As an organization, it is also important to walk the walk. So, what are those specific metrics and targets which you have to communicate to the market in terms of what you're focused on? For us as EcoBank, this is something that we've been taking very seriously. We are one of the signatories to the United Nations Principles of Responsible Banking. We've subscribed to the Equitable Principles several years ago. We've always, for the past 10 years, been having disclosures in our annual financial report just to talk about what we're doing from a sustainability standpoint, because we believe that you have to think about the long term. And there's no way you're going to think about the long term without thinking about the impact of your operations in terms of what you're doing to the society at large, whether from a social or climate point of view. Thank you.
Thank you very much, Ayo. I think quite some food for thought there. The main one that stood out for me was really a tone from the top. It has to be cascaded, just from the very highest levels so that it permeates the entire organization, and there is a recognition for what the thrust for sustainability and ESG is as a corporate citizen. So thank you. I'll just ask Tunde one last question in this segment, and then we'll move over to the more focused conversations, as we are also mindful of time and we want to be able to take in some Q&A down the line. So Tunde, in terms of skilled labor and the exodus that we see, not just in banking and financial services, but across a number of real sectors and indeed the entire economy. What are banks doing to ensure that talent is retained and developed, just to give Nigerian banks the competitive edge, as local players, but also within the international space?
Okay, thank you very much. Banks and indeed other institutions probably have to do a number of things, but from a banking perspective, I'll break it into two. Number one would be around the sourcing for talents. We've realized now that in sourcing for talent, it's not the traditional approach that you just go in and say, please come and apply to this institution. Now you have to be more deliberate and more intentional in selling the experience to the potential candidates. So when we, as my bank, go to universities now, we go and first of all do hackathons, where we challenge bright young minds, come and give us ideas to solve a societal problem. So we're not just going to say, come for a job. Say, no, come and pitch to us on how to solve the problem. And on the back of that, how can we work together as an institution to realize and solve that problem? So as potential employers of labor, it's now to realize that you're competing with even entrepreneurship spirits. People that don't want to come in and do the regular 9 to 5 anymore. People that don't want to sit in front of social media and engage and have fun and make money while having fun. People that are looking for other things outside Nigeria. So you have to show them that it's more than just a job, it's an experience. So a lot has to be done from the onboarding and recruitment point of view. Even in that onboarding, as people are coming into the organization, what tips, what things are you doing to make that process seamless? Now, the harder part is the retention. and retention, institutions now need to realize that the name of the game has changed post-COVID. How do we create an environment where people belong? So first and foremost, yes, you still have to ensure competitive remuneration. You have to pay people well. You have to ensure that people at least have enough compensation to sort out the basic elements. But embedded in that are the little work-life balance initiatives. So as traditional banks, we still love wearing tie, wearing suits, white shirt, blue shirts, and what have you. But we realize that post-COVID, people want a lot more flexibility. But how do you balance that flexibility with having to still appear as the prim and proper banker? So dress codes now, we don't just send out formal dress codes. We call people to come and pose as models and come and show people what kind of dressing we want in the organization. We now do, in some areas, TGIFs. In some areas, ensuring that we train and retrain. So it's now a complete package. Institutions now have employee experience officers. They have not just the old school total rewards or total compensation. Now it's all about employee experience. So there's no clear-cut answer. It's a combination of several initiatives, also depending on the industry that you work in. But embedded in all of that is the realization that old school approaches might not work anymore. We need to be ahead of what the economy and what the environment is saying, and just create an environment where people feel among people belong to, feel that they are part of a larger mission. And I think slowly and gradually we'll get better. Thank you.
Thank you. Thank you very much, Tunde. I think very apt and applicable to everyone on the call in terms of employee engagement, development, retention, training, and upskilling. Thank you. We've had a really good conversation around the general concerns that keep our executives awake at night, and as Tunde said, during the day as well. We'd like to move, into a more focused conversation. So against the backdrop of the recent announcements by the Apex Bank around, the reorganizations that need to happen in our financial systems locally, and how it positions us more on the regional and international scene. I'd like to just go into each of our panelists and get some thoughts around how they're thinking of the developments and indeed how they're positioning as well. So I'll start with Dio. Dio, in terms of the recent recapitalization announcements and what it means for a number of banks, we've seen some banks come up with initial thoughts around, how they're thinking of positioning in order to meet the new guidelines. But what are your specific thoughts for the banks that, are thinking of options of M&A and injection of new capital? What do you think banking executives should be doing right now around those thoughts and options?
Sorry, I missed that, Bimbo. Was that for me?
Yes, Dio, that was for you. So we're talking about the recapitalization announcements, how the Apex Bank has rolled out, the new guidelines for the industry players. And so my question was around, what your thoughts are on how banking executives should be thinking of options on M&A, injection of new capital. What do you think banking executives should be doing right now?
Okay, thank you, Bimbo. I guess this is the big elephant in the room when it comes to banking today. And I'm sure both Tunde and Ayo are having sleepless nights in terms of exactly what needs to be done. Our approach is this way. First of all, is what are the reasons for the recapitalization drive of the central bank? When Ayo was talking, he spoke about the RWA inflation and the impact it has on capital. And to the extent that banks do have components of their balance sheet in foreign currency. When we did have the devaluation of the naira, it meant that the capital adequacy ratio of banks, if you look at it between 2022 and 2023, would have dropped. And as of today, it's even dropped further. So the number one reason is, first of all, to be able to shore up the capital of banks so that they can absorb unexpected losses in the future. And some of those losses could actually be attributed to some of the gains that banks did post last year. A number of banks, reported revaluation gains. That's one of the reasons why the central bank decided not to include retained earnings in that, even though that is debatable. The other reason is because generally there's a trust by the central government 31, and banks.
Dio, not sure if you can hear us, but your network is unstable. Maybe we'll give it some time and just come back to Dio in a short while. So let me move to Ayo. Ayo, what is your take around the CBN reforms, especially the recapitalization drive? What do you see as the challenges and opportunities in the medium to long term? And just for housekeeping, I'm sure all of us are enjoying the conversation as it's evolving. Just mindful of the amount of time that's left so that we can squeeze in some M&A. So I'm going to ask the panelists to just give us 2 to 3 minute responses going forward. Thanks, Ayo.
Thanks, Bimbo. I expect to see transformation in the industry similar to what we saw 20 years ago. So it has to be transformation because at the end of the day, each of those banks would have to determine what do I need to do, just like the CBN is saying, you have to come up with a capitalization plan, right? Whether you want to generate capital, whether you want to merge or acquire, whether you want to downsize. I think generally my expectation for the industry, you would have, of course, banks raising more capital. We've seen a couple of them holding EGMs or sending notices of EGMs to raise capital. You have more capital. And of course, the constraint of having more capital is what exactly do you do with capital, right? Because you can raise capital and then you put the funds sitting on your balance sheet as cash, right? So those capital raise will have to fund maybe new loans, perhaps supporting more of the real sector of the country, or whether you want to further grow in terms of acquisitions. And I'm talking about, the banks with international license. So if you're going to raise that quantum of capital, perhaps you might see some of these banks also increasing their presence outside of the country. So it's also another way of kind of edging their risk rather than being totally focused on a Naira economy. So I expect more capital to be raised. There might be a couple of few M&As in the market. I expect to see a couple of other banks also revise the business model to say, why should I be, for example, a national bank? Right? Why can't I be a regional bank? Because eventually you can still basically continue to do every other thing other than having branches in some parts of the country. So I expect that revision. It might be difficult for an international bank to revise its business model to say, I'm no longer an international bank, I want to be a national bank. Then the question is, what are you going to do with your presence outside of the country? So I expect the international banks to remain the same. I expect some, of course, national banks to also revise their business model or to also evaluate opportunities for M&As. But in summary, I expect transformation. But at the end of the day, as a CFO, of course, capital is not cheap. There is a cost to capital, right? So if you look at a point in time are cost of 25%, 30% range. So if you're going to raise capital or do an M&A, you have to be absolutely sure that on a going forward basis, you expect to generate the right level of returns to compensate for the cost. So I'd like to pause here. I'm sure other panelists would also have their thoughts and views here. Thanks.
Thank you very much, Ayo. I take from you what you said. I expect transformation, and I think we're all super expectant as well around how the landscape will transform over the next few years. So Tunde, I'm gonna ask for your take on the debate around retained earnings. I know it's been a thought driver for a lot of industry participants, but also in terms of swaying the Apex Bank on how to think about this. What are your thoughts on whether retained earnings should be considered as one of the options for recapitalization?
Thank you very much. Interesting question. I guess number one, the reality is every banker, what his or her source has been aware that the capital regime was going to change at least in the last 2 years. The prior CBN governor had announced at the beginning of the second term it would change capital. The new CBN governor also hinted that was going to change the capital regime. I guess what we all underestimated was the definition of what will be called capital. What's expected in line with Basel standards and global changes. They made the new announcement. Yes, the top one has been this issue of retained earnings, and trust me, there are many schools of thoughts as there are bankers or even analysts. But I guess so as to tread on the side of being politically correct, the expectation from the regulatory agencies is largely that we want fresh inflow of cash into this industry. We want fresh inflow of funds, of equity, of capital to come in. Sometimes you can debate the components of retained earnings, how much is real cash, how much is based on accounting classifications or adjustments. But the feedback is, guys, go and bring in cash. Yes, they also give the caveat that all elements of capital adequacy competition will still remain. So in some sense, some comfort, but in the real sense, some more work to be done. And I guess as the last speaker said, whether or not retained earnings or other elements are included, it is as we raise, as we determine the approach to take as decisions, we also need to think of what next. The capital regime of 20 years brought about banks expanding across Africa to other parts. So we will expect a lot more complexity in the business landscape as things go on. So to answer your question, we've been told to do an assignment. We have no choice than to do the assignment. And really, it's all in the interest of the country to get the economy, to get the industry stronger, to get the economy stronger. So just to say, watch this space, and maybe we'll have another conversation in 24 months to see how all the banks are fared. Thank you.
Absolutely. Thank you, Tunde. Thank you. Right. So, let's get some thoughts from our internal panelists. Just given your perspective as FSI leader and the various conversations that you've had to date, what are your thoughts around the risk, the capital, and the accounting considerations of the recapitalization exercise? So we all think of Akin's area, which is the go out, raise the cash, get the partnerships in. But beyond that, the implications around risk, capital, and accounting, both during and post, for most of the players. What are your thoughts around that?
All right, thanks, Bimbo. Just listening to what Tunde said, I think Tunde, you tried to avoid that. Speaking more in detail with respect to whether retained earnings should be considered or not. Yes, I think it's the whole exercise obviously has the pros and cons, but of course overall we are looking at all of the benefits which one cannot really quantify. Clearly, it's the right direction to go. But in terms of the specifics, of course, there are a few areas of challenges. Ayo has mentioned some of them. Dai also mentioned, and today clearly also mentioned some of the, certain areas where one might find it quite difficult to navigate. But the point here is while we banks, are thinking through a plan, it's important that they also look at the risk and capital implications of what they are doing. And 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 what that means is that the plan has to be enveloped, around a model that looks at how things will pan out in terms of the direction they want to go, whether they want to go by M&A or they want to raise, fresh injection of capital or whichever, upgrade or downgrade. There has to be, how will this work out? If it's M&A, how does it affect risk and capital? How does it affect, if it's a fresh injection of capital, how will it also affect, risk and capital? And when we're talking about the risk areas and capital areas, from a regulatory perspective, what comes to mind is really around the ratios. So whether they are leverage ratios or liquidity ratios or even the capital adequacy, I clearly and rightly pointed out that with the with dollar, with foreign currency being a major part of balance sheet, clearly it had impact on capital adequacy, when the currency began to devalue, in the last couple of months. So that is something that the banks need to begin to think about as they go the direction of M&A or injection of capital, because you need to look at what will leverage ratio look like pre and post recapitalization. What will liquidity ratios look like? What will capital adequacy look like? And one will think that because you're going to be injecting new capital, as in fresh cash coming in, or through M&A, you're going to be issuing, acquire shares as currency for payments to acquire, other banks. One would probably think that, in the short term, that the ratios will look quite good, quite impressive. But I think the point here is really what banks are to do post recapitalization. So you are awash with cash, you have quite a lot of money. What do you then do in terms of what you put them to use in terms of qualifying capital? Because these are the things that are going to determine the ratios post recapitalization. So depending on what you're doing, whether you're investing in high quality liquid assets or you're investing in assets that have significant credit risk, that will, of course, then determine how some of these regulatory ratios will be going forward. From an accounting perspective, clearly, irrespective of the options that are being considered, there are a number of accounting considerations. I was discussing with a colleague recently. For banks that are thinking of downgrading, for example, so if you're downgrading and you are going to be operating as a regional bank and you have branches in other parts of the country, you probably then begin to look at decommissioning some of the assets that you have in those places. And a standard like IFRS 5 non-current asset, the non-current asset held for sale, discontinued operations then come to mind. And but overall, irrespective of the options that you're going to be considering, there will be significant, accounting implications in terms of disclosures, and also some specific accounting standards, like the financial instrument standards, will be something that the banks need to begin to model and see what that impact will be on their books. So that at the end of the day, you don't have unintended consequences in terms of how your balance sheet structure looks like. I think I'll just stop there for now, people.
Thank you very much, Uyi. And I think a number of our participants may like to take that conversation forward going further. But thank you for the views. I'm mindful of time. I'm going to ask Ashata to just share with us, Ashata, your views on tax and regulatory issues around the recapitalization drive. in just a few minutes, and then we'll hear from Aki. We do have a few questions in the Q&A already, and we'll try and go through those subsequently. Over to you, Asha.
Thank you, Bimbola. This question is very important because, as we probably all know, tax is one of the biggest expense consideration when you're thinking about any transaction, much less capitalization that may involve fresh injection of capital, acquisitions, mergers, etc. And also, I think Tunde mentioned earlier that one of the things that keeps everybody awake in this sector are regulatory risks. So all of these are rife with regulatory issues that we need to be mindful of. So top of mind that I would just share around what the indications may be would be: one, strategies around evaluating the options. So we had issues around what we should consider around evaluating the options. But from a tax perspective, it will be a question of what are the exposure, what is the possible exposure for the bank? Are there incentives that can be evaluated, that can be taken advantage of? So I'll give certain examples around the options. So if you're talking injection of capital, you definitely have to think about creating new shares. By new shares, what are the stamp duties and implications that can be significant, and there are other filing considerations. Are there ways to minimize this, especially if you are thinking around right issues or having consideration of existing shareholders? So that is one option or one consideration. As part of the strategy of determining the option two, would be considering acquisitions. So we've had issues around strategic acquisitions. How does this be? Prior to, I would say, 2020, sale of shares and acquisition of shares within the Nigerian market was free of taxes. But since 2021, that has changed. So irrespective if it is, even if it's part of strategic acquisition, normal buying and selling of shares, there's now tax. So the question is not, they may not be taxed for the bank, but the question is, how do you ensure that all other regulatory compliance relating to the tax payments by the other party has been dealt with to ensure that the bank has protected? And then when there's acquisition in itself does not solve the problem that we're talking about, or the issue, does not address the issue that we're talking about, because we have acquired shares in the companies are still two separate entities. They still eventually have to merge. So upon the merger, what are the implications or what are the incentives that we can take advantage of? Prior to, again, there have been changes in the Nigerian tax sector over the past 4 years that have brought in changes different from the way we used to know it, especially what was in play when the last round of capitalization, mergers, etc. happened. Now there are rules around mergers and acquisitions. Prior to now, mergers and acquisitions will just be tax-free, so long as, from a capital gains tax perspective, so long as there's no cash payment. But now that has been changed, and there are some thresholds, there's some conditions that banks need to be mindful of. So there has to be they have to be part of one group. 50% threshold may be a likely trigger here. And then the question around maintaining assets and control 365 days prior and 365 days beyond. So I know that if this is a consideration, the time to act is now, because we know we have 2026 deadline for closure. So to take advantage of the timelines that have been infused in the tax laws now, the time to act is now. So if it's going to be straight up merger talks, by all means, and then subsequently, if that doesn't solve the problem, it may end up leading to additional capital, but it may at least create a better base for some companies to determine what they want to do. So these are some of the things that we need to be mindful of. We've talked about re-strategizing again around operations, whether the license that parties require. So we've talked about the licenses, whether it's going to be regional now, or it's going to be national or international. I think we and some of the participants also mentioned around what would happen to the assets that are not being used. Would they be taken to places where they are available? Are there landed properties that may have to be disposed of? What are the implications of that? There are other tax considerations that need to be mindful that all the parties need to be mindful of in this consideration. And all of this need to come with more evaluation. There's an impact on the employees, there's impact on all the regulators. So they need to carry on now, because we have in Nigeria, we have about 38 tax authorities. So there is the Federal Inland Revenue Service, and then for each of the states, how to carry them along. If they're talking mergers and acquisition, how to deal with FCCPC, which is the Federal Consumer Protection and Commission. So that is one, and how all of this impact the employees too need to be mindful of. So it's a long process. There's 2.5 years, but we just sleep and wake up and the time is over. So the time to act, especially to end, needs to start now. So from a regulatory perspective, there are several. We've talked about the CBN, obviously. Most of the banks are listed. So we're going to have considerations with the Securities and Exchange Commission, the NSC, and irrespective of the option that we are considering, a lot of these regulators have to be considered. The implications, how we need to engage, what are the documentation that needs to be put together. All of these have to be evaluated, and it's not something that can just be done at the whim of at a snap of finger. Some banks have maybe experience around this because they've done one or two in the past. Some may not, but again, as I said, the regulatory and the tax landscape have changed from where the last major transactions that we were aware of is from today, and all of this has to be. We need to be mindful of all of this as we go ahead. If there are further considerations, I think I may have to shed more light on some of the other issues, maybe some of the tax issues that that emanated from some of the issues that keep them awake. We can talk about that later, but in the interest of time, I'll just stop now.
Thank you, Ashata. Thank you. And over the next few minutes, Akin, if you're happy to share any M&A considerations, we'll make it as succinct as possible, because we have some questions in the chat box already. Audience, we are enjoying our time with you. We'd like to crave your indulgence for an extra 10 to 15 minutes after the allotted close time of 11:30 so that we can address your questions. Akin, over to you.
All right, I mean, I'll make it short, straight to the point. I think the first thing that I would like to mention, so that we have more time for the Q&As, you just give me a phone call, get Deloitte on your side, and we get you sorted for the M&A. But more importantly, I think I need to get people to think about, one, what has happened in the past. If you look at the whole banking landscape, you could divide them into two: those that have grown through M&A and those that have not grown through M&A, that have done organic growth. So if you're a bank that's been doing M&A growth, I mean, there are some things you need to consider. You have to sort of look back and see, what are the lessons learned? How did you burn your fingers in the past? What could you do better? And I mean, what your choice of who to merge with now has to be clear. You have to be sure of the synergy you are going to deploy, the opportunities for growth. And then all this has to be clear from day one. And you also have to think wide, post-integration, post-merger. How do I continue my life after that period? So what system do I need to think of? What my auditors, how do they need to come in and carry on as business as usual? All this has to be well thought out from the point of your choice of you're going to merge it or acquire. And for those that haven't done it before, that have not grown through M&A, and as a result of this new regulation, they have to now deploy the M&A option. Then they have to think of, one, what are the mistakes those that have done M&A in the past, what have they made that we do not want a repeat of? And then I think what is really sound is to get a trusted advisor that has done this before, bread and butter for the person, and really has a global, so you can have a global player giving you local nuances also. So that is quite critical. Your choice of advisor will make or mar you in this, especially if you haven't got experience in growing via M&A. I think I'll try to leave it there. We can talk about specifics that folks may have, and it's been nice to just throw it back to the panel to get response to the Q&A in the chat box.
Thank you. Thank you very much, Akin. So we're going to go to the Q&A right now. We have quite a few questions. I'll start with a question from Bimini Laulu Adewale, and Dio, I'll be directing this to you. Bimini's question is, in light of the recapitalization drive, what is the plan to protect consumers, that is, bank consumers? Many are confused and planning on pulling out their funds so they don't get stuck in the middle like we saw happen in the past. Thank you, Bimini Laulu Adewale, for this question. Dio, if you're there, perhaps you can give us your perspective on this. Dio, you're muted.
Okay, I was just saying that, thank you, Bimini. That's a very important question, looking at all of this from a consumer or a customer point of view. The fact is, first thing is, the essence of recapitalization is to make our banks stronger, so that we do not have issues of financial losses, particularly when the bank collapses. So that assurance needs to be taken, and I believe, I think some of my colleagues have also mentioned that we're going to be having a bigger, a stronger banking system prior to that. And the best way to look at it is look at 20 years ago when we had the first recapitalization. Customers were afraid, customers were concerned, but post that, the emergence of the new banking sector is such that the sector is able to provide better, seamless, bigger services to customers. But it's important as the banks explore the different options, particularly when it comes to M&A or downgrade of banking license. So for M&A, just to ensure that it is seamless, like the partner mentioned, it's important that there's an alignment of business and cultural strategy. There's proper due diligence. There's elements of customer assessment before you choose your partner to merge with. And for banks that are choosing a downgrade, particularly maybe from national to regional banking license, where they currently have physical presence, how are they going to provide services to customers? The good thing is that with the advent of technology, you really don't need brick and mortar branches to be able to provide services to customers. Overall, I think from an assurance point of view, the essence is to ensure that we have bigger, stronger banking system, but also with the new capital coming in, banks will be able to deploy more advanced technology, so that customers can have better experience and their assets are also protected. I just want to give that assurance. Thank you.
Thank you very much, Jayo. I think the public sentiment does have to be very carefully managed. The good thing is we have some experience. We've done this before as a country, and hopefully, this is a much better exercise on the strength of our learnings. So we have another question from Femi Oloyede. Femi has two questions actually, but I'll roll them in one. And Ayo, I think this is better directed at you, just given your conversation around the foreign currency tilt. Excuse me. So Femi's question is, if banks are trying to increase the foreign currency components in their capital supply to improve the Naira equivalence of total regulatory capital and its attendant adequacy implications, the high foreign currency component portion in the risk-weighted assets of banks, does it mean that the banks see a further naira depreciation in the medium to long term?
Okay, interesting question. So yeah, so thanks. I think, of course, as a CFO, I'm not going to speculate in the exchange rates of any currency. But if you look at the research reports, as far as exchange rate determination is, it's a function of several factors, right? So it's not just one factor. So you have to look at your inflation differential, right? So you look at what is inflation in Nigeria and what is inflation in the US. Because if you're looking at naira to dollar exchange rates, a fundamental determinant is your inflation differential. So today, our inflation, which was just released, was it yesterday or 2 days ago? I think yesterday was about 33.1%, right? The core inflation, of course, is lower than that. So one can argue that, okay, your long-term average of inflation might be much lower than that, but it's still much higher than what is the average inflation in the US. So if you just plot that graph, that inflation differential, on a theoretical basis, you would expect the naira to depreciate relative to the dollar on a theoretical basis. But of course, there are other factors which come into play. Your export versus import ratio and all of that, the state of your current account deficit, the level of your foreign direct investment, the interest rate also has a role to play because with our interest rate environment, you can have hot money coming into the country, a lot of foreign portfolio investors and all of that. But if you hold every other thing constant, just like the economists will say, all things being equal, you would expect some level of depreciation between in the naira to dollar exchange rate. And I think most banks are aware of this. So every senior banker is aware of this. So what is important is to be able to position your balance sheet accordingly, because you know that this is something that will happen. It might not happen in 6 months or 12 months, but in the medium long term, you would expect some reasonable level of depreciation, all things being equal. So I think I've answered that question because technically you need, of course, to have some level of foreign currency and capital stack as a natural edge, in case you have the risk-weighted asset inflation. Thank you.
Great. Thank you, Ayo. Thanks for that. And we have a question from Jimmy Ogobine. I'll direct this question to Tunde. What key learning points and pitfalls from the last recapitalization exercise do you think we can learn from / avoid in this current exercise?
Good question. I guess first and foremost is the governance process around capital management. The last one that was done 20 years ago it came as a huge shock, and everybody was running helter-skelter. The governance process is not as robust as we have today. So one major area the industry and I think institutions need to learn from is putting together the right governance structure, board oversight, regulatory oversight, making sure that things are done a little bit better. There are one other major learning is perchance there are potentials for M&A. I guess at that last period too, there were a number of regulatory nudges. Right now we have a 24-month time frame where people should weigh and check and dot their I's, cross their T's before potential M&As. Because we see some of the M&As post consolidation that has some strain at the edges. I think even from the central bank point of view, we've gotten better in capital verification, checking sources of capital to make sure that they are not from funny sources, to make sure that it's not from loans from other institutions. So just those little checks and balances around governance and making sure that we all do things the right way. And I think over the last 20 years, the industry has gotten better and has gotten a lot more mature. I think we're in a better position than we were 20 years ago. We believe things will be done much better. Thank you.
Thank you very much, Tunde. I think, I agree with your submission around how we should look at this and just learn from a few of the past lessons. So we are hard pressed for time. Thank you for granting us an additional 10 minutes. We will need to close the session. I want to very specially thank all of our esteemed panelists who have spent the last almost 2 hours with us. We know how expensive and precious your time is, and we don't take it for granted. We've enjoyed the wealth of conversations, the insights, and the nuggets that you've shared with us and with the audience, and hopefully we can take this collective learning into our different organizations, and it can help us shape growth in times to come. We have a few other questions that we're not able to attend to, but just acknowledging David, Thaddeus, and Ariel. We hear you. We will aim to come back to you through another medium on some of your questions and concerns. We've also had some requests to share a recording for this session. We'll look into that, and we do have the details of everyone who has joined us. So we will look at the possibility of sharing this with you, just given that there was some fragments of time based on network that maybe some of the views were not caught as clearly. I'll invite Mike Daudu, our audit leader, partner and audit leader in Deloitte, to please give us some closing remarks. And again, thank you to our audience, our very engaged audience with the great questions, and to our panelists who have given us the time. Thank you, and we look forward to welcoming you to this platform very soon. Mike, over to you.
Yeah, thank you so much, Bimbo. It's been a very, very, very insightful time. I think we spent a very good quality time. I must reiterate, and I can't thank our panelists enough. Special appreciation, Ayo, Tunde, and Dayo. You certainly brought your views on to bear in terms of what the greater challenges in a fast-changing industry. We don't want you staying up at night, but we know that the part of the objective of discourses like this is to see how we can really shape direction in terms of things we need to do. So I want to thank you once again, and we certainly will be calling on you in the future as the landscape continues to evolve. We talked about a bit about the recapitalization aspect, but I think it's something we plan to do a proper deep dive on. So we certainly will be circling back to you and making sure we get your broader views around that. Again, I must thank the Deloitte team led by our FSI industry leader. This is a well put together session. I know it's the first of a series in terms of some of the interactions we'll be having with the broader stakeholders and the community out there within the financial services space. So thanks to you and your team for highlighting something that is quite topical now, and which is a front burner for a host of us within the sector. Akinola, thanks to you as well. Bimbo, excellent job moderating the session. So we know we'll certainly be calling on you to do that as well. And Asiata, I'm not going to leave you out too. Thanks for your perspectives. But more importantly, I think to the audience who have participated, I mean, we couldn't have made this a success without your full participation. And as Bimbo did mention, we probably couldn't have time to go over all the questions, but we'll certainly make sure in due course we'll respond to them and probably make available the recordings as well for further use and learning. So without much ado, I know the day is fast spent. I want to wrap it up at this point and say look out for more in terms of the series of interfaces we'll be having with the broader stakeholders out there. A lot is happening within the banking space now, and there's no better time to be well positioned and to be ready to, really make hay while the sun shines. So thanks once again, and best wishes from all of us in Deloitte, particularly from Fatai, our CEO, who would have loved to be here, but due to other pressing commitments, I have the best wishes from my executive team as well. Bimbo, it's a wrap. Thank you.
Thank you very much, MFD, as we fondly call him. Thank you again to our esteemed panel and to the audience. Have a great afternoon, everyone.
Thank you.
Thank you.
Thank you. Bye.
You never know how far one idea will go and who it will impact. Like her family, their community, our planet. At Deloitte, we measure ideas by the impact they'll have. Because why work so hard to find solutions if it doesn't make a difference in people's lives? Why connect, or innovate, or engineer anything, if not to make an impact that actually matters? No matter who you are, where you are, or where you're going, Deloitte is there, and there, and even there. We are dedicated to helping people and organizations solve problems, to know faster, to grow farther, to go from red to black to green. Creating impact where it matters most.